Let's look at the key terms in income tax, the keywords that we shall need. Yeah, when we are dealing with income tax. The first one is a taxpayer. Yeah, according to income tax, a taxpayer is a person who derives any amount subject to tax under the Income Tax Act. And further, it includes any person who incurs an assessed loss for a year of income and any person required by the Income Tax Act to furnish a return of income. An assessed loss refers to a tax loss for the current year, and then furnishing a return is like giving information to the tax authority about your income. Yeah. So a taxpayer is a person who derives any amount subject to tax, and then that person incurs an assessed loss and is required by the Income Tax Act to furnish a return. That's a taxpayer according to income tax. Then we look at a person. The definition of a person according to income tax differs from the common man's understanding. Like, normally, a person is just a human being, but according to income tax, a person refers to an individual. It can be a partnership, it can be a trust, it can be a company, a retirement fund, a government, a political subdivision of a government, and a listed institution. All those can be called a person according to income tax. So later on in this topic, if we mention a person, we shall be meaning either an individual, a partnership, a trustee, a company, a retirement fund, a government political subdivision, then the government itself, and then a listed institution. Another key term we have is gross income. Gross income refers to a person's annual total amount of business income, employment income, and property income. So it is an addition of someone's business income, then the employment income, and property income. That is gross income. Gross income means something that is, gross means something that is general. Yeah, so it is the total income. Yeah, and we should note that gross income of a resident person includes income derived from all geographical sources. If you're a citizen of Uganda, your gross income can be an addition of the income that you derived from abroad and the income that you derived from Uganda. But gross income of a non-resident person includes only the income that is derived from Uganda. For example, gross income of a person who is not a Ugandan, for example, an Indian, yeah, it includes only the income that they derive from Uganda. It's what we consider as their gross income. Another key term we have is chargeable income. Chargeable income is the gross income of a person, less total deductions allowed under the Income Tax Act for the year. Yeah, so in order for you to get chargeable income, you must have gross income, then you less deductions that are allowed to be deducted. Then the amount that you get is what we call chargeable income, and it's where the tax is charged. So it is the gross income of a person, less total deductions allowed under the Income Tax Act for the year. Another key term we have is the year of income. Year of income refers to the period for reporting on the taxpayer's affairs as well as paying taxes that will have accrued. So that period that they take to report the taxpayer's affairs is what we call the year of income, and it's normally 12 months. Yeah, so year of income is divided into three. We have the normal year of income, and this refers to the 12 months period ending on 30th June. It ends on 30th June, meaning that it starts on 1st July. Yeah, and that makes it 12 months. Then the second one is called the substituted year of income. Yes, substituted year of income, if you're not okay with a normal year of income that ends on 30th June and starts on 1st July, you can apply in rating to the commissioner so that they can give you permission for you to use another year, like for your year to start in any month that you'd like. You may be there and you want your year of income to start in March, yeah, and end in Feb. So you can apply to the commissioner in writing. After that, he will have to approve still in writing to give you permission to use a substituted year of income. Yeah, therefore, a substituted year of income is a period of 12 months other than that ending on 30th June. So for you, you change. If you don't want the normal one, you don't want to be normal, so you apply for a changed year of income. Then we have the transitional year of transitional period. It means that period when things are changing from one state to another. You're changing from this to the other. So the transitional year of income refers to the period between the last full year of income prior to the change and the date on which the changed year of income commences. The period of you changing from the normal year of income to another year of income, the period in between is what they call the transitional year of income. And it is treated as a separate year of income, yeah, regardless of either making 12 months or exceeding 12 months. It is treated as a separate year of income. Other key terms we have is business income. Business income, as you can hear, business income, it's the income that comes from doing business. So it is any income derived by a person from carrying on a business and also includes a gain on disposal of a business asset or debt cancellation. It also includes the proceeds from disposal of trading stock and interest income. So it refers to that money that you get from doing business. And they say that it also includes the money that you get from disposing or selling of business assets or when your debt is cancelled. Then it also includes the proceeds of selling trading stock, the proceeds of selling stock of the business, especially closing stock. Then interest income. Yeah. The income that you receive for giving out a loan. Yeah. So that is what we call business income. It's mainly the income derived by a person from carrying on business. Another key term we have is property income. As you hear property income, it's the income that you derive from using property or from exploiting or utilizing property. And it can be any dividends, interest, annuity, natural resource payments, rent, royalties, and any other payment derived by a person from the provision, use, or exploiting of property. It can also include any value of any gift derived by a person in connection with the provision or exploitation of the property. And that is what we call property income, the income that you get when you're dealing with property. For example, if your tenant gifts you a car, it is regarded as property property income. Yeah, if they give you any money that is not rent, it is also regarded as property income because they are giving it to you because they are your tenants. Yeah, if they were not, you wouldn't have gotten it.